Righto, Money Miners. Just, how good's the bloody new setup, Ricky? I just sit back and enjoy mining.
It's getting there, mate.
Mate, she's all happening today.
Day.
Bit of a M&A evolution, win the race that we didn't really know was happening for Northparkes.
It was on. It was going on in the background for a while. There was plenty of articles in the AFI. It'd gone quiet for
Any word on the decline
for a little while, but it was no secret that CMOC wanted to pass this one on.
Looking forward to getting into how a majority copper mine gets to lower a gold all-in sustaining cost. Anyway, we'll get into that. Trav, you got another one of your little passions to go through today?
I can't help myself, mate. I normally have a bit of a market cap filter, but I always break that rule for the beautiful potash industry, Matty.
You know, the potash industry should thank you and you alone, because if you weren't here, JD, would you cover it? I wouldn't even.
I'm not sure he's done it any sort of favours. He just covers it.
Maybe.
It's two worlds colliding as well.
if
It's
it was-
administration as well as a potash project.
If Trav wasn't here, you wouldn't even get highlighted. So anyway, cheers, Trav.
No worries,
mate. And tomorrow we were going to do TMT AVL, but we're going to save that one, eh?
Yeah. I think shareholder revolt, mate. Everyone's trying to block deals,
Shareholder revolt.
including now disgruntled shareholders trying to band together. So their scheme booklet dropped today. I started reading it this arvo before we ripped, and I think there's an interesting story to tell there, which we'll tell tomorrow.
Oh yeah, and I might even do old Blackstone bloody nickel acquisition.
Old Zipo.
Yeah, we'll see what happened after the Zepos didn't get approved. We'll go through that tomorrow too. Right, now, clarification from yesterday's episode. I don't know if it's like a pure clarification, but interesting. They're talking about the IRA stuff and the new rules. There were different news centres reporting it very differently. So initially in the upload yesterday, we put that places like Greenbushes and Mount Marion would be affected because of the Chinese subsidiary ownership. But then, so that's how the AFR reported then. But then Bloomberg, on the other hand, reported that if it had to be Chinese government owned, and that Chinese subsidiaries that weren't government controlled, it didn't apply. So we went bloody at 6 o'clock last night, me and JD, flying the flag for the money miners, went deep into the government report. But
We did. And
it was a definition thing. So there was a definition for what a foreign entity was, but then further down there was a separate definition of what a foreign entity of concern was.
Yeah, that's right.
So
and it is a draft. It's out for comment at the moment as well. So these aren't finalised either. But yeah, it remains to be seen. We've even reached out to more people today and they've told us a few contradicting ways of interpreting the draft that's been put out. So it remains to be seen what it actually looks like. But if you want a bit of a guide, you can look at the CHIPS Act, which came out, in the past year and a half as well.
Not the IRA, but they also have that definition of foreign entity of concern within the CHIPS Act.
Yeah.
And in there it's explicit that all FEOC parent company subsidiaries and investments are covered by it. So I think the majority inference that is out there in the market is that the guidelines, once they're finalised and rinsed through the market, the intention of those guidelines will probably be to exclude, the Greenbushes structure from eligibility of IRA compliance.
So anyway, we'll give further info when it's all not drafted and finalised. So
Absolutely.
That's why it was taken out. We just in case. You got to be quick in this industry, JD. Fuck, she's all go in the news centre. Anyway, right, mate. I did a Google search. I was thinking, what rabbit hole could Google take me down? And I typed in mining sustainability news. Thought go outside my realm of interest usually. These things come up. And you know why it's pertinent?
Why?
Because of this guy. Benny Swan. Have a look at his face. So you look at these news articles I found, and I'll tell you why it's pertinent. Look at this. EPA launches criminal proceedings against Newcrest Cadia gold mine for alleged air pollution.
Bad news.
If you swipe in this guy now, and he was involved, probably not in the news at all.
No, it wouldn't have happened.
Wouldn't have happened.
Wouldn't have happened.
Deep Sea Mining, a new gold rush, or environmental disaster. Ben Swan, I'd class him as a deep sea mining expert.
Yeah.
And like you have him on your team, headlines like that don't pop up. Slap on the wrist for Rio Tinto and Fortescue after breaching environmental regulations in WA. I don't see Rio Tinto or Fortescue on the previous client list for Future Proof. if they were, wouldn't be in the news for that sort of stuff. You bring in this guy, Benny
Ben
Swan, all sorted.
Mate, with a surname like Swan, you're pretty in touch with the, ecological, factors of Perth.
Exactly. He did a lot of his deep sea mining sort of initial research, trialling it in the Swan River.
Did he? Yeah.
Yeah, hence where the
where he
name
learned,
Ben Swan come from. So, look, anything ESG, we've already touted Ben Swan as the ESGC of the industry. Mate, if you need sustainability framework done up, because, Jesus Christ, I know from experience that sustainability framework is an absolute maze to go through. You don't want to go down that road without some expert advice from people like Ben Swan at Futureproof. Give him a buzz.
You got lost in that maze, Matty.
Oh, I needed Ben Swan. He actually come in and got me out of it. That's what he does. What a bloody legend.
We should put Sandfire and Futureproof in touch after their latest events in the past week.
What were they, JD?
They destroyed some heritage artifacts.
Oh, the one at
near
DeGrussa.
DeGrussa. Yeah.
Yes. Well, another example. If Ben Swan was involved, likely
Wouldn't be talking about it.
Wouldn't be talking about it. Oh, speaking of other GCs in the industry, if not being the RC drilling and hand rock breaking experts was enough, the fact that K-Drill have now expanded into the diamond drilling division in the surface, courtesy of the bloody great man Steve Swallow that's on the board. On board now.
He's on board.
He's on board. He's on the board. He is the board.
He's swallowing up the competition. They're swallowing the competition.
You could say he got bored of his last stuff.
Yeah.
And then now he's on the board of K-Drill. He's on board. Mate, what an offering.
What do you reckon the K stands for in K-Drill?
Kalgoorlie, isn't it?
I'm not sure.
I think it's Kalgoorlie or crushing.
Capable with a K.
Crushing with a K.
Crushing with a K. Do you think there's a bit of who's the big dog in town contest going on between old Swallow rocking up and obviously Ryan O'Sullivan, the incumbent sort of big wig at K-Drill?
It's the new and the old, but you've got to be able to, pass down the wisdom.
They could do week on, week off of who's the big dog, like go on sort of a cycled roster, because I don't know, that much sort of excellence in the building at one time, like you can't have two Chris Ellisons at min-res.
If they were to arm wrestle, who'd win?
It's like, I think it wouldn't even get to the arm wrestle stage because Swallow's hand would be broken off just on the exchange of hands when Ryan gets a hold of him. Mate,
Get to the exchange of hands.
mate, if you want to go see a live arm wrestle at K-Drill headquarters, there's one happening next week. And while you're there, you'd be stupid not to ask about the diamond drill rigs they got there for the surface.
Or the RC rigs as well.
Or the RC rigs.
Don't forget that.
Mate, and
Next week's ad.
Swallow and
It's
Ryan.
just an arm wrestle.
Yeah, there is a live arm wrestle happening this week. I've just scheduled it. Go see the two big dogs, Steve Swallow and Ryan O'Sullivan. Jesus Christ, I'll sort you out some bloody holes.
Just don't shake Rhino's hand.
Don't shake. Just be aware when you go in and don't let him get you short because it fucking hurts. All right. Thanks, K-Drill and Futureproof.
Legends.
ESGCs
Champions.
and GCs of the industry. Right, let's get into mining news. We better not forget that, JD. Mate,
M&A again, mate.
M&A.
Your favourite.
Evolution buys Northparkes.
If ever there was an asset that had Evolution's name on it, then Northparkes was it. $150 all-in sustaining costs. That's just screaming Evolution.
Is that the cheapest gold mine going around?
No.
Ernest Henry.
Ernest Henry, mate.
Oh,
Negative.
Oh, who owns that? Evolution. Oh, Jesus Christ. How do they? Let's figure out how they get their costs so low. Mate, how many bucks they pay, JD?
So they paid US $400 million for this upfront, plus
So $400.
$400 US bucks, and up to $75 in contingent payments.
So about 600 Aussie bucks. Today.
600 Aussie is the upfront component, and then we'll get into the.
We'll go right into it later.
Yeah, well, Matty, I can see you've done a dive into the history of.
Interesting. Looking at who was actually going for it, the AFR reports today they beat Metals Acquisition Corp, and apparently Sandfire and Aeris were looking at it as well.
But pulled out early.
Yeah, pulled out. Weren't actually in the final stage. So,
Matey, I'd hope to step on your toes here. You've gone into the history and
did you ask me to do it? Oh, I didn't. another one of my little crusades.
I think I actually told you the history of this one's fascinating, so you should
Why not
dive
expand
into
on
it.
Yeah, so it's people know it for Rio Tinto,
Yeah.
but
I didn't know that.
didn't you?
I actually did not know
Yeah.
that.
So it was the first ever block cave mine in Australia,
Yeah.
and under Rio Tinto, but it was caving before that. So
And it sits in New South Wales for those wondering.
in Parks, probably one of the coldest places in the bloody world. It is freezing. I had a hockey carnival there once. Fucking, it's where the bloody dish is.
Yeah, okay.
Yeah, that's the dish.
Yeah.
That's in Parks. So the original company that had it to get it approved it into operation was North Limited. So they approved the block cave and the open cut mines and concentrator in 1992.
Yep.
So North Limited subsequently formed the Northparkes joint venture with Sumitomo Metal Mining and Sumitomo Corporation, which we will go back to because they are also still
They remain 20% owners. That
they
is,
are
yeah, it
the
should
other
be
20%. Evolution are buying the 80%. So they've been in there for a while. So that was obviously for the downstream smelting and refining capability. So as I said, first ever block cave mine in Australia, but there was a very unfortunate tragedy at Northparkes in 1999. So this was a year before Rio bought it. There were 4 workers killed from an air blast there. So you're looking at the coroner report, there was 14.5 million tonne of material collapsed from the roof of the cave and sent an air blast through the entire mine. And actually, it could have been a lot more fatalities because it actually happened during a maintenance shutdown. So there were only 65 people underground at the time. So there could have been a lot more. And because 2 of the workers that passed away were actually conducting the hydraulic fracturing of the cave to help it cave. The coroner report said they deemed that the mine was maintaining a production rate a lot too fast for how much the cave was breaking into it. So because there's that big gap, all that material let go and that air has to go somewhere and just went through the whole mine. So yeah, massive tragedy.
Horrible.
So one of the sayings you always hear in the mining industry is procedures are written in blood. So which means that a lot of the cave monitoring and the real strict conditions on cave monitoring are because of this incident. So every procedure on a mine site is either because someone's been hurt or someone's been killed. So that's why they're so strict on making sure there's monitoring to make sure that there's no big void and the cave is actually propagating. So yeah, very sad. 1 year after that, that's when Rio Tinto then acquired North Limited, $3.5 billion takeover, and there was a big battle with Anglo American.
Was this the sole asset at the?
No, so North this wasn't even
Okay.
This wasn't even what they were after really. So the takeover was motivated by so North Limited in 1999 proposed they wanted to have the Rio Tinto's Pilbara railway line, like the network declared as open access. So Rio Tinto just thought, we'll just take you over then. Because the big assets at play were Robe River iron ore mine, which then expanded into West Angeles. So you're about, I think that's the huge operation. They also had the Iron Ore Company of Canada, IOC. So that's, I think Rio Tinto have still got that. Then you also had the Ranger uranium mine. So that come out of North Limited, also known as ERA, then Northparkes as well.
What a mismatch of sort of mines.
Yeah, so they're pretty decent sized
uranium, iron ore, and copper.
Yeah, so Rio took it over by 2012. It had a capacity of 6.4 million tonne per annum, and they fully automated the mine, the haulage, so the bogging and the haulage in 2015 from that E48 cave. So they were I think they were one of the early adopters of automation because it's a hoisting system and everything. So then CMOC, which we'll go into, China Molybdenum, you will pronounce it better than me, they acquired Rio's 80% stake in 2013 for $820 million. So CMOC were the ones that did the automation, not Rio, sorry.
Yeah,
So,
yeah.
so 2022, it's expanded it to what it is today, 7.6 million tonne per annum. and they're permitted to go to 8.5. So have a look, but you have a look at the grades that have come out. This is for a 4 year period back in up to 2021. 0.5% copper, 0.54% copper, and 0.17 grams per ton gold. So it's not on the lower end, but
yeah. You normally look at that and think, geez, that's not economic, but because it's a cave and the geometry of the ore body and everything like that, they make it work, right?
I've got a special. I went deep into Excel out of my wheelhouse today, boys, and we'll get to that later and figure out, is this a low cost operation or not, based on the figures Evolution give us. So yeah, but huge resource, 101 million tons in reserves and 628 million ton in resource. So at that current mill run rate, it's like, what's that, bloody 13 years of reserves plus 5 times as that in resource. So
it's a long life asset.
Big copper gold porphyry deposit. Just massive. So JD, what is the deal, mate?
Yeah, just on the mine life, they advertise it as a 30-year mine life. We'll round out on a couple other aspects of the deal itself. So they're going to produce a concentrate with silver, gold, and copper. The copper con offtake terms are standard, to quote the call this morning. The gold and silver is in a stream to Triple Flag, which we'll get into later. They're also raising Aussie 525 million through an Insto equity raise, another 60 million in a share purchase plan, as well as 200 million Aussie in a 5-year debt facility. So the repayments on that will only start in the third quarter of FY25. So, Matty, you've gone through a lot of the details there. One other thing to note with the resource and reserve is that it wasn't JORC compliant. CMOC obviously not being an ASX listed company, they didn't have to play to those rules. In terms of FY24 guidance, they're talking about 25,000 tonnes of copper as well as 38,000 ounces of gold. So on the mill capacity, 7.6 million tonne per annum is what they are running at the moment. It was interesting to hear Jake and the team on the call say that they were very keen to play down the expectation that they would get up to 8.5 million tonnes anytime soon. They didn't want any analysts factoring in those bigger numbers and building in expectation. I think that's a good way to sort of play analysts, keep the expectations low and beat them on the upside.
I think, because I didn't know, I might be wrong here, but most of the previous production looked at around the 6.5 rate. I think even from what they're doing now to get to the 7.5.
Yeah, so pre last year, it'd been 6.5 million tonne per annum for quite a while. So from underground, my understanding is that it runs at a 6.5 million tonne per annum rate, and that you can periodically, using stockpiles and open cut mining, get to 7.5 million tonne.
Easier to crush to send it through. Yeah.
Exactly. So something else they were quite eager to stress on the call is that plenty of capital has been sunk already.
And that's just how a block cave works. You got to not that all of this is block cave, but majority it is, but the main cave they're going to be drawing from at the start, it's all just big decline, 2 levels at the bottom, your undercut and your extraction level. Once it's in, you're just bogging. Might be a bit of rehab and popping oversize and stuff, but it is what you define as a rock factory. No jumbo development. Once it's set up, there might be small bits here and there of rehab, but it's just a rock factory.
Yeah. So the big bits of CapEx will be when they want to bring on new ones. You can see from one of the maps will show up, there's these sort of pods that just go deep into the earth. There's plenty of them. So big CapEx bill. I mean, we'll have heard plenty of times in the past and in the future, acquirers invariably say that this asset has a lot of sunk capital. That's just what companies say when they're buying something to...
Yeah, well, this is actually genuine sunk capital.
Yeah.
There's a hoisting system.
Yeah.
You're just down there bogging rocks.
It's not like typical long hole open stoping where you've got to continuously do more development.
Yeah, you've got to do levels and levels. Yeah. This is just mining the whole block. But there will be, as you said, for the other pods, the other systems, they will have additional capital put in, because they're talking about a lot of... You see them talking about one being a potential block cave or sub-level cave. So it's whether Evolution want to allocate the capital to turn that into a block cave and delay that, because you've got to get right to the bottom and develop the whole thing, or sub-level cave is not as optimum, but you start getting ore straight away. Yep. So it's how they're going to treat, if they're going to treat this asset like a BHP or a Rio, or they're going to treat it like a sort of not a second-tier miner, but a mid to large cap.
Absolutely. So we touched on the all-in sustaining cost of $150 per ounce. So
What a bargain.
yeah, hilarious.
I think a while back, Cadia actually went into negative.
Yeah,
at one
yeah,
stage.
just like Ernest Henry.
I mean, that's
Free.
Yeah.
So, Matty, you jumped into whether we should be looking at this as a copper mine or a gold mine. It's quite obvious, but
Yeah, well, when you look at the actual, if you just go off the predicted ounces and predicted copper tons, times it by the commodity price, the copper revenue, it doesn't include payabilities and everything, but the copper revenue is nearly triple what the gold revenue is. So quoting this all-in sustaining cost as $1 per ounce and taking off the copper credits, when it is a copper mine, it is a copper mine. It's a bit weird, isn't it?
yeah, and you compared the mining cost just to put this sort of operation in comparison with a Liontown, Kathleen Valley type of project.
I learned how to backsolve all-in sustaining costs today to convert it into C1 costs with the help of my good friends here. But I'll bring up the bloody spreadsheet. So if you look, so it says they got an all-in sustaining cost $150 an ounce, and then
Well, it just highlights how dumb that metric is. As an all-in sustaining cost.
exactly. So to convert it back, you got to the all-in sustaining cost has had the copper credit taken off the actual all-in sustaining cost to convert it into a gold all-in sustaining cost. So you got to they put it's in the fine print down there how you figure out the actual gold equivalent to convert the copper into it. So it does. Well, if you use 7.5 million tonne per annum, it comes out. Feel free, anyone that thinks I haven't calculated right, let me know, but I'm pretty sure it's bloody right. C1 cost per tonne of $42 Australian per tonne.
Well done, Matty.
That is bloody cheap.
Per tonne of ore, they're
Per tonne of
Yep.
ore, they're hoisting out a
Yep.
7.5 million tonne per annum rate.
So the big question is, what's their net smelter return per tonne of ore?
Well, that specific Trav, JD's done the work on that, and Respeculator's put a big tweet up, so we'll leave that for him. JD will tell us if it makes money or not. So you break, because you look at the actual, and everyone says what's the dollar per tonne? You see the C1 cost. So if you look at the old CMOC operating costs, I'll just use the ratio that they use for mining, underground, open pit, processing and G&A. So it comes out at the underground will be about $11 a tonne per ore. So you look at remember Liontown came out with their increased costs. Remember they've got jumbo development, trucks hauling up, people in the trucks, people in the boggers, and they were looking at about $100 a tonne. So it shows all this sunk capital and this rock factory, what that does to the actual underground mining costs. This is predicted, but this is based on some back of the envelope, pretty bloody close. But yeah, around $11 a tonne, or 16 total for open pit and underground. So very, very cheap to actually operate it. But remember, it's half a gram, 0.5% copper and 0.1 and a bit gram gold. So you need to operate it cheap to actually make sure you get the money out of it.
And of course, you do have to put the upfront capex to get that development into the ground.
And it's residential, so you haven't got planes, you haven't got accommodation. Everyone just lives there. It's a local workforce. So that obviously helps with it as well. So a lot on the side there.
So before we dive in a bit more into what the what the metrics look like, we should touch on the stream they've done with Triple Flag. So as a quick reminder, stream is just essentially selling the right for somebody else to buy your product. In this case, the gold and the silver at a set or at a specified price. So you're getting upfront capital and you're selling it generally for a huge markdown. So
how did this stream come about, this Triple Flag one, right?
So CMOC essentially wanted more cash. I think they got in the region of
550?
550 million. And whether that was to develop, I didn't look into more, but perhaps that was to develop other parts of the mine. They wanted that upfront capital. They were focused on the copper. They didn't stream that away.
So they streamed part of the gold.
So they streamed all of the silver and a percentage of the gold. So for the gold, they're streaming away 67.5% up to 630,000 ounces. And then after that, the percentage halves. So for the streamed amount, they'll get 10% of the spot price. And then for the remainder, the other 32.5% of the gold that they sell, they'll get the normal spot price. On the silver front, like I said, they are streaming out 100% of the silver.
Yep.
And that goes up until they've streamed out 9 million ounces. After that, that halves as well. And similar to the gold, they're going to get 10% of the spot price in
Gotcha.
return. So effectively for roughly the next 17 years or so on the gold front, they are producing 13-ish thousand ounces of gold. That's attributable to Evolution after you take in the
So do you-
streaming.
given that, do you think we should be thinking of our unit costs in relation to gold or in relation to copper?
I think you can put 2 and 2 together there, Trav.
But this is the Evolution playbook, right?
Yeah, and there's also a tax advantage on the reporting front of that stream, which we won't get into. That's a bit more detail. So onto the sort of analysis around the price. In one of the opening few pages of the deck that they sent out, they quoted an EV to EBITDA using FY23 EBITDA of a 7-time multiple. So that was EBITDA of US 107 million and an EV of US 756 million US dollars. So we obviously spoke about an acquisition price. It was quite different to that. So it's a bit confusing at first when you look at that EV and you think, how did they get that? So what they're using is US 400 million upfront payment. They're not talking about the contingent payment at all. And then they're using a US $356 million fair value of the stream liability. So that roughly...
Treating it as debt.
Yeah, exactly. That roughly 350 million is treated as debt. So you add it to the upfront payment to get you roughly 750 million, which they've used.
Can they get themselves out of the stream? Could they pay their way out of it or not?
I'm not sure about the contractual terms of a buyback. I didn't see anything about that, but for all intents and purposes, like you could probably offer, Triple Flag something, but given they are a royalty and streaming company, like you'd have to pay them top buck.
Yeah. Like we spoke about a $550 million going the other way price tag. On the method that these guys use, I don't like it. You've got to trust the fair value of the stream, and you're also looking back at last year's earnings. So I don't think it's a perfect measure. You'd rather just look at what you've actually paid and look at the EBITDA or whatever earnings metric you want to use and see what you're actually going to earn.
Attributable, yeah.
Yeah, so that's a bit of it.
Yeah, price to cash flow, whatever, yeah.
Exactly. So we could say that they're paying US 400 million and not use the contingent, factor in a slightly lower copper price, considering that those contingent payments are contingent on the copper price rising. That's roughly 600 million Aussie. And then you could use a lot of the assumptions or terms that they've put forward on recoveries grade, payability, treatment and refining cost, royalties and so on, then apply the actual stream. We won't go through like all the numbers. Matty, you quoted a rough cost before. You could subtract that to get a margin and then, assuming
that's
that
your annual cash flows.
Yeah, exactly. Assuming the run rate of 7.5 million tonne per annum, you could get a margin in the sort of vicinity of 50 million bucks per annum Aussie. And we're talking about a 600 million Aussie price that you're paying. You're coming out at roughly 12 times. Obviously, they're fairly rough numbers that we're using, but it's a pretty significant multiple. But it is in line with a lot of the other acquisitions that we've been talking about in the past. So
yeah,
when you get into like, why did Evolution buy Northparkes and, some other thoughts that we've got about this, the first thing that comes to mind is it's kind of like a marketing thing, the way I think about it. They can put themselves front and center on their presentations as having a super low all-in sustaining cost. They'll screen cheaply on all these metrics. People looking to just allocate blindly to the gold sector will say, hey, these guys look like a low-cost producer. I'll allocate to them.
It's 100%. We talked about this with Jake Klein when we interviewed him.
Yeah.
We sort of dug into the whole, when people think of Evolution, they think of our lowest cost, gold producer, but it's when you think of it in these rudimentary terms, like all-in sustaining cost, which is, a delusional way to actually think about cash generation because of the way that the copper credit kind of feeds into this stupidly low number when in reality, Evolution quarter on quarter is losing cash.
100%. It's a it doesn't actually reduce your overall costs. It's just an appearance thing.
Yeah, but it works. It gives them like they traded a far greater multiple than peers because of, I think, this perception and maybe the copper exposure and all the rest too.
Yeah, on the copper exposure, that's another great point. Their FY24 guidance now factors in about 30% of the revenue coming from copper. So there's been a bit of a theme that we've spoken about, gold companies bidding for and trying to buy copper assets. That's not going away anytime soon. You've got the added benefits of broader investor appeal. Perhaps it falls into the mandate more of generalist investors. It's also, just a bullish statement on where copper prices are going at the moment. So the last thing I want to make comment of about this acquisition is the multiples being paid for by companies in the copper space. So that roughly 12 times, like we said, it's not the first time we've seen it. My opinion is that Evolution aren't buying Northparkes assuming copper stays at $3.80. They've got the added benefits of all the marketing and all that we've just touched on, but they're clearly quite bullish on copper. They haven't streamed away. Granted, that was all factored in from deals that CMOC had done in the past, but I think that they're bullish on where copper is going and they want to get more exposure to that thesis as well as all the other reasons that we've just stated.
So with that all-in sustaining cost, the streaming and everything, are they going to make money from the asset?
Yeah, whether it looks like the asset will make money, right?
Yeah.
But the question's not will it just make money. The question is like will it make money, and if you NPV the future cash flows of the money it makes, does it equal the price you paid for it?
Yeah, is
And
the price-
600 million.
Is the price
Yeah.
exactly? Is the price you paid justifiable? That's the question to ask, and time will tell. You can't say that right now, but
there's definitely a trend though, right? Of like people loving the long life copper assets, and they're willing to trade these, pretty high, willing to pay these high premiums, like 12 times for a mining asset is not very common. Like definitely not very common, but you're willing to do it if you're getting the optionality that comes with like a 30-year whatever mine life. Because if you take a buoyant view on copper market, then you expose yourself to the super profits in the periods of time when you have elevated pricing, and if you also have expansion optionality on top of that, then your returns can look even more attractive.
Is paying a multiple like that, can that be a reflection on not needing as much capital to put into the project? They will have to put capital in eventually, but straight up they don't. Does that affect how you perceive the multiple they've played?
I mean, our multiple for clarity doesn't actually factor in what your sustaining capital is. That's basically like an operating cash flow multiple that JD's like plucked out there. But you're 100% right. Your best analysis is a price to free cash flow multiple, if you were to do a multiple, in which case you'd factor in your sustaining capital each year, which, to your point.
And your growth capital?
Yeah, I mean, life of mine, you'd NPV it all. And to your point, that's actually going to be net lower than other types of mines. Yeah.
Look forward to the analysts bloody releasing their reports and we'll just regurgitate them. So
there's another question I wanted to ask you too, JD, and that's like, what does it mean for CMOC? Is there a read through on what's happening here? Like CMOC wanting to sell this asset, do you think?
The way they phrase that is that it wasn't a part of their, strategic way forward. We've learned over 6 months not to take what companies say at face value, but in terms of actual copper assets, I think they can make a lot more money from their assets in places like the DRC. We've spoken in the past about companies like CMOC having a lot less, restrictions around how they operate in places like the DRC in comparison to a ASX listed company. But I think you can kind of take them at face value and say, hey, they're happy to get this cash in the door and focus on their better cash producing operations overseas.
And another perspective too is we just talked about the IRA, like clarification, right? Evolution owning this asset is eligible for IRA compliance, but CMOC owning this asset is not eligible for IRA compliance. So, the two entities might actually achieve a different price if you believe in a bifurcated price environment too, depending on, just which entity owns it.
And CMOC would have been well aware of that in their negotiations. You'd anticipate that their advisors would be able to use that in what they called a highly competitive process to extract value.
I can think of another gold mine with copper credits that will be on the market soon.
Oh, what is that?
Telfer.
Oh, yeah.
Imagine if Evolution, if they continue this trend, they might be looking at that one as well.
We asked Jake about that when we spoke with him, I'm fairly sure.
Yeah.
What did he say again?
Do you think it'll be on the market? I haven't heard the latest.
Well, who knows? But if you think of some of the logical ones, as we said in the Newmont presentation, Telfer is not on their list of projects on the big graph.
Yeah.
Because it's not classed as a tier 1 asset because it hasn't got the mine life So
I
will they?
noticed Greatland's share price has run the last month or so. So yeah, we should revisit that one, Matty.
So if that is the got evolution, if this one's got Evolution's name all over it, you think those ones might too? They might be might be a go big or go home strategy for Evolution.
Does that one actually make money though?
Oh, I think it needs drilling.
Yeah,
it's one of those ones. There's gold everywhere. It's whether it has to be defined and a mine plan put around it. I'm not up to date on how much drilling is done there.
Another perspective on that one too is I think a lot of capital has to go into, Telfer and to bring Havieron online and all the rest of it if you could wrap up both Telfer and Havieron. And when you think of what Evolution's done here, they've funded this with majority new equity. It's not like Evolution is sitting on a giant pile of cash for them to go and deploy on both acquisitions and the whatever capital plan. So if you think of I think there's just an open-ended question on how Evolution would go about funding that, even if it was possible for them to pursue it, given the fact you've got to pay a fair bit up front, but you've also got to, throw a bit in the ground to get the outcome you want there.
Havieron's a difficult one just because of the distance away from Telfer and the scale of it. Yes. Anyway, we'll see.
Let's talk about some potash.
Oh, I tell you what, some days I get to work and I think, geez, I could use some potash in my life. And Trav's come through with the goods today and just cured the itch.
I hope today was one of those days, mate.
Today was one of those days.
Because you're in luck.
You guys have talked about it. Yeah. I've got to wipe about 3 zeros off of the deal quantums when I talk about this one. So Reward Minerals is wrapping up Callium's Beyondie project, and some more details have come out in relation to Reward Minerals and what the deal looks like. And of course, Beyondie has been a contested asset because Callium's been in administration since August. Now, Reward, they're paying $15 million up front plus $5 million deferred to fund it. Reward are aiming to raise $23 million via a capital raising. I thought unpacking this deal could be a bit of an educational exercise to understand what actually happens when mining assets go bad. If you think of the upfront cash consideration here from Reward to Callium, let's try and figure out where does that money go. So do you remember when Callium went into administration? It had a market cap of about $50 million. And I guess the question to you guys, do you reckon those equity holders, anyone that owned shares back in August when it went into administration, do you reckon any of them will get any money back?
No.
I would say no.
All right. So on top of the equity holders, right? So it was 50 million equity. They also had about $200 million or $200 million in drawn debt. The lenders
$200 million. That's like what 200 trillion.
I'm confusing bucks. So.
I was going to correct you, but you're in a flow, so keep going.
$210 million in drawn debt. That was to NAIF and KFW. And I think the big question is, do you reckon they're going to get anything back? And I won't force you to give me an answer yet, but I've had a troll through the public disclosures uploaded on the voluntary administrator's website, and I'll tell you what I can deduce, fellas.
You've kind of given us the answer with the price that was paid up front, right?
Yeah, but so $15 million up front, right? Do you think any of that's going to go to KFW and NAIF?
Cents on the dollar,
right,
a marginal amount.
I'm gonna paint my case for why I actually think they're going to get zilch, or if you could round it down to zilch. I reckon it'll be extremely close to 0 cents on the dollar, if not 0 cents on the dollar. And I'll tell you why. When Callium gets put into administration, that's a costly exercise in itself. You've got to fund all of that. And it looks like the lenders, NAIF and KFW, probably didn't provide an additional finance facility for this costly exercise. They did let Callium draw down $10 million that was still remaining in a liquidity facility that was previously undrawn. So Callium still had to fund this process, right? And the costs keep stacking up. So what did they do? Well, I could deduce that they got this new facility in place from GCI, that's Global Credit Investments Special Opportunities Fund. Assume this facility ranks super senior to the debt from NAIF and KFW. And while I can't figure out what the quantum is yet, that will roll through when the doc is out, but currently, based on the information out there, I'm going to guess that this facility is between $5 and $10 million that was, provided to Callium from GCI. On top of this, in the announcements out today, you can also see that Mick Ruan's entity, Tyson, so he's got an entity called Tyson, that also lent Callium $8.75 million. There's a loan. That loan was funding Callium, which went towards prepayment of the debt outstanding to GCI. This facility appears to rank secondary to GCI's facility, but senior to NAIF and KFW. So think of it like this. $15 million in upfront cash comes in the door. That's got to pay out whatever is left from GCI plus Tyson. Then there's transaction costs. You've got to pay the financial advisor, the receivers, the administrator, the lawyers. Then the DOCA is structured. This DOCA is the proposal that's put forward from Reward Minerals. That's structured so that some employees are made whole in terms of what they're owed. Then there's a pool of about $250K earmarked for unsecured creditors. And the way I read it, whatever is left when you've finished all of that goes to NAIF and KFW, which I would venture to say is sweet fuck all.
Yeah, right.
So going into administration is not cheap.
That highlights that Trav's not throwing darts here. Look at the work that's gone in. He probably thought at the start they're going to get fuck all, but he has gone through it. Bloody absolutely tore it a new arsehole, and as evidence of why they're probably going to get fuck all.
Yeah, not much to share around there.
I mean, like shareholders, they have to, put a like if you were a shareholder in Callium, put a line through it. You're not going to get any return. Lenders that invested a few $100 million will get a mighty return that I'd venture to bet to say you can round down to 0 cents on the dollar. Keep in mind, right, that's a return on taxpayers' money. NAIF is an Australian Commonwealth entity, and I'd venture to say it'll be 0 cents on the dollar to them.
Very, very sad for shareholders, isn't it?
Mate, sad for shareholders, sad for lenders. KFW is a state-owned German bank, development bank. Why do I think it's important to pull apart this case study? I just think it's conceptually interesting to think that senior lenders in project finance, so these are the lenders who literally they get security over the asset, right? Do you think, isn't it strange and crazy to think that your maximum downside is literally 0 cents on the dollar, that you can have as a senior lender? I mean, there's no other kind of lending in where you get security over the asset I can think of where you think, geez, my actual max downside here is I will lose all of the principal. It's a really, really strange dynamic that does happen in mining when the commercial realities of the project don't eventuate.
Yeah. Because it goes bankrupt because the project doesn't work, and then having collateral over the project really isn't worth the paper it's written on.
Especially when you got a lot of technical risk, unproven for whatever reason, be it a new technique, a new geography that you're deploying things, and all that sort of stuff that the West Australian potash industry did endure.
Good work, Trav. Love your work, mate. Righto, we'll go TMT AVL tomorrow.
We sure will.
The revolt and I'm actually interesting that I'm glad a bit of M&A's found its way into December to keep the show going.
All the bankers are trying to make sure that Christmas isn't ruined by getting the deal done right now.
Yeah, I know. It sounds like Jake Klein was really enforcing that there was a heap of people that hadn't slept for 3 days to get this sorted. So, sweet as righto. Thanks to our sponsors at the top of the show.
Yeah.
ESGCs, NGCs of Future Proof Consulting and K-Drill. Our new partners, InvestorHub, that we pumped out yesterday. Buddy, great. Check them out.
Loved it.
MDs. Get onto InvestorHub.
That's it.
DSI. It's been verified by Money and Mine. So
got the tick of approval.
It's got the green. It's got the blue, the green, all the ticks. DSI Underground, Terra Capital, McMahon Mining Title Services, Anytime Exploration Services, Seamus Murphy, KCA Site Services, Brooks Airways. Love your work. Love all yours. Cheers for supporting Money and Mine. Thanks, Money Miners. Hootaroo.
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 The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.